Hello and welcome to Canaccord Genuity Wealth Management. I'm Stephen Jones, an Executive Director within our Wealth Management team, and today I'm joined by Angus Coote, Co-founder and Executive Director of Jamieson Coote Bonds. Being at the tail end of a 10-year bull market, where investors have been blessed with double-digit returns, it seems somewhat strange to start a conversation about bonds, where traditionally the rate of return have been in the low single digits. However, now is the exact time to have that conversation and reiterate its importance in a diversified portfolio. So today that's what we're going to do, and that is answer the question of why bonds should be forming a part of your portfolio. Angus, let's start not so much with bonds, but with Jamieson Coote Bonds in its entirety. What are the origins of the firm?
Sure. Firstly, thank you very much for having me. Jamieson Coote Bonds, or JCB, have been around for nearly 6 years. We established the business in 2013. Myself and my co-founder, Charlie Jamieson, decided to start a product which purely focused on the government bond element of investing in bonds. Now that is important to work out because government bonds are the highest grade bonds you can possibly invest in. Traditionally in Australia, people have been investing in sort of corporate debt or investment grade paper. The Australian government bond market hasn't been something that people have traditionally been investing in, whereas offshore it's a cornerstone asset class. And we decided, we were fortunate enough to learn our craft offshore. We spent 10, 15 years in those deep and liquid bond markets offshore, where cornerstone asset class, as I said, sort of 20 to 50% allocation in many jurisdictions, yet in Australia we have a 10% allocation to bonds. We wanted to bring that skill set back to Australia and provide investors with the ability to defend and protect their portfolios in times of stress. As you touch on, in periods of benign periods that we've experienced over the last 10 years, bonds produce mid to low single digit returns. But in the true risk-off periods, high-grade bonds really do diversify your portfolio. More recently, we saw that in the December quarter of last year, in December 2018, in the 2018 period, where government bond index returned 5.2%, and the ASX was down 3.2%. So it gives you that negative correlation kicker. But if you look back further afield to the financial crisis, we saw a period where government bonds rallied very hard because people are worried about return of their capital, not return on capital, and we had a 20% return versus an equity market that was down 30 or 40%.
Let's go back to the capital stack. There's a number of bonds all the way from corporate, there's credit, there's debt. Jamieson Coote, what do you focus on and what do you avoid?
Look, we just focus on the highest grade AAA rated Australian government, Commonwealth government, state government and supranationals bonds. Supranationals are bonds issued by World Bank, AAA rated. They don't provide as much liquidity as the Australian Commonwealth government do because their funding needs in Australia are not as great. But we just focus on that highest grade bond piece. It is the most conservative asset part of the bond investing silo. If you go down to the corporate space, you're investing in equity-like products, but you're above the equity stack in terms of if there was a wind-up of the company, you get paid back first. So it is similar sort of risk to equities in terms of corporate bond investing. We steer well clear of that. We're just investing in government bond paper in Australian dollars, I might add.
And you mentioned before internationally, our fellow investors domiciled in America and the UK, they've had bonds as part of their portfolios for centuries. Mm-hmm. We haven't. Yeah. Why is that? And why should we be reverting to what these guys are doing across the water?
That's a very good question. Well, the bond markets offshore have been very deep and liquid for centuries. Mm-hmm. The Australian bond market was paid down so much by the Howard and Costello years, so much so that we almost didn't have a market that existed. We had the financial crisis come through and we saw a huge wave of bond issuance from the government to fund deficits that we've had for the last 10 years and going forward. And now we have a deep and liquid bond market that is verging on $1 trillion that you can invest in, whereas 10 years ago we wouldn't have been able to start this product because the liquidity just wasn't there. Now we can transact in many billions of dollars at any particular day and get your money back. It's a very, very highly liquid product, which is very important. And those big markets offshore are highly liquid, and that's probably the reason we haven't seen a product like this in Australia for probably 30 or 40 years.
2019, a lot happening globally, and a federal election coming up as well. We've just come out the other side of a Royal Commission into banking, which is yet to really play out its part from a credit standpoint. What are the key themes you're looking at?
Well, domestically in Australia, we are obviously worried about the housing slowdown and how that will impact the household sector and therefore the economy. The RBA have pivoted on their, looking to raise rates from where they were to a more, the next move could be a cut. We've certainly been talking about that for a period of time. We think they could cut substantially. We think that is something to watch out for. Obviously, a change of government would be very distracting for the economy. And something that people need to focus on. And if the RBA do cut rates, that is very good for bond investors. Probably not something that we could talk about today because it would take too long to explain. But it is a very supportive environment for bonds. More generally, globally, we're worried about corporate credit. There is a huge amount of issuance in corporate paper, and a lot of that is at the lowest investment grade that could flow to junk and therefore forced selling. Liquidity in corporate paper is very, very, very thin and not nearly as good as equities.
Thank you, Angus. To wrap up, 2 points as I see it. One, be aware of corporate credit and the products that are currently out there in the market, particularly given the illiquidity of those particular assets. And secondly, investors should be asking themselves the question, do they have enough defensive assets in their portfolio? Do they have enough liquidity given where we are in the cycle?
Sure, I agree with that. Look, I think that investing in all those products that we've mentioned, they are a fantastic investment, but you have to think about this late stage in the cycle. We're 10 years, 11 years into a recovery, and I mean, you don't want to, fortunes are made in the ashes of the previous cycles. You have to, as an investor, work out how much risk do you want to take at particular points in the cycle, and arguably, I'm not going to forecast this, but we're getting late in the cycle, and our product, government bonds, is the most conservative product out there. Governments don't die, they can continue to tax citizens, they can privatise things, and our product in general, it is a benign product in a normal environment, but when you get into those risk-off periods, it comes alive. So sort of 1 to 2 out of every 10 years, this product can produce reasonable returns, high single digits and above.
Thank you, Angus. For any further questions about inputting government bonds, Australian government bonds within your portfolio, please contact your Canaccord advisor. Thank you very much.